The longer higher rates go on and the more deposits move to perceived safer places, we're going to see more consolidation in that sector.
Mark, I am so excited for this. We had so much to discuss in our first episode that we simply couldn't fit it into one. And so first, thank you so much for joining me for a second time today.
Well, Harry, thanks for having me back. I wasn't sure you would ask me back, but yeah, there's lots to cover.
I think this is the perfect time to have you back, Bluntly. I have so many open questions. Before we dive into the core of the show, though, I just want to do a cliff notes, which is really unfair, especially given your career. But what is the cliff notes on your career and the core highlights you'd dive into?
Okay. Well, quick cliff notes. I mean, I guess I'd say I've worked pretty much at the intersection of private markets and public policy most of my career. So I started in the city just before the fall of the Berlin Wall, so probably before you were born. Kind of rode the globalization boom from there in Asia, in New York, a bit in Canada with Goldman. Then I became a central bank governor in search of a quiet life. I figured, 8 interest rate meetings a year, and I could spend time with my family. And my timing was a bit off because I started a few weeks before Bear Stearns failed. And then obviously that cascaded into the subprime crisis and Lehman, et cetera. And so I got involved with the financial reforms after that, picked up from where Mario Draghi left off on leading the financial reforms, went to the Bank of England, during the Euro crisis, Brexit referendum, focused a bit on climate when I was there, given the responsibilities. And now I'm back more on the private side. So that was a long period on the public side, but a public side where working a lot, obviously, trying to fix and reform private markets. And now I'm back on the private side, focusing in a couple areas, most of which relate to climate. So I work with Brookfield. We have a big transition fund. We focus on going to where the emissions are and funding companies to get them down. I'm on the board of Stripe, a great fintech company, and more. I work with companies like Watershed, which help with the mechanics, the ERP, if you will, of climate to help companies get down. And I do spend, just back on the public side, I spend about half of my time as a special envoy for the United Nations. It sounds great. And for which they owe me, I get $1 a year and they owe me $3. So they're in the bad debt category. I've been doing it for 3 years. And in that regard, I work to kind of organize the private financial sector to address climate change, but in a way, and the last point, which is, I guess, the theme of my career, in a way that gets the power of markets to deliver the things that people want.
I mean, first off, maybe I wouldn't be single if I had the title of Special Envoy. This could be the secret unlock to my love. I'm very envious of that. The second is well done for surmising an incredible career in about 150 seconds. But I want to start today on a core, which is in the last show I said, Mark, I haven't seen a boom and I haven't seen a bust and I haven't worked through that cycle. I feel like that is changing. And so help me, Mark, where are we now and what follows a bust?
Yeah, exactly. So I guess in the last time we were in the middle of a boom or probably towards the end of a boom. And for students of economic and financial history, they'd be familiar with something called the Minsky cycles. And what you have in those cycles is it starts with something fundamentally good, some big innovation. It could have been the productivity miracle in the U.S. at the start of the 2000s, the first bits of financial innovation that helped develop subprime lending as an example, blockchain and DeFi as another example. And so these are fundamentally good innovations, but ultimately the growth turns to boom, turns to euphoria, and then turns to the phase that we were pretty close to. I think we were just on the cusp of last time we spoke, which is what this guy Minsky, the economic historian, called the Ponzi phase, which is a phase that you recognize is a phase where you're lending against the asset that's at the center of the boom on the assumption that the asset's going to continue to rise. So it's asset-based lending with price appreciation absolutely built in. And of course, at some point, there's the so-called Minsky moment. You turn to panic because the assumptions are removed, and we lead into despair. So we're at that phase, certainly, I think, in the DeFi crypto universe. And what's interesting about that phase is, provided you'd avoided getting over-levered in the Ponzi phase. What it brings is tremendous opportunity because the underlying innovation was real. It's still there. You've seen what works and what works less well. There are some assets that can be picked up, and there's much, much less capital and available to, that's competing with you. And so this is the time after the boom. We've had the bust, and this is where opportunity comes really into play.
Can I ask, can you provide me with an example of an innovation that went through this cycle, experienced this Ponzi realization moment, but had underlying value to the innovation that then was kind of reborn efficiently? Because in my mind, it's just like people realize it's a Ponzi scheme and never come back.
I'll give you an example of a financial innovation where that's the case. So, the collateralized loan market, CMBS, collateralized mortgage-backed securities, got taken to, the assumptions underlying them got taken to ridiculous extremes, Ponzi extremes. So the price appreciation built into those structures in 2006, 2007 brought literally the house of cards crashing down. But the core innovation there lives on, and I think has served the market quite well, the financial system as a whole quite well. And we've ended up actually with a much more robust, it's not totally robust to be clear, but a much more robust, what some would call shadow banking system, I would call non-bank finance, that's providing a different channel of credit, and actually, given what's going on in the banking sector, a very welcome example of credit. I think you're also asking, though, about a fundamental innovation that, has gone up and down through the boom-bust cycle. And I think the example a little closer to home for me would be in hydrogen, where we've had a couple of those euphoric cycles. The last one was early 2000s. We're entering another, and I think a much more solidly grounded one. Time will tell, though. I can't actually give you the example of hydrogen fully deployed in a way that's mainstream commercial. I think it's coming. I think it's coming in the next few years. So maybe if you have me back in a few years, I'll be able to nail that question.
And I will have a special envoy as a title by then. So we'll both have won.
Exactly.
I want to also say, you mentioned you touched on the banking situation. Let's put it that way. We were talking before about FRB being in turmoil. I just want to understand kind of where we are there, Mark. Is the banking crisis over?
Well, you're always careful with your words, and you started with situation, you ended with crisis. I'd put it more in turmoil. So I guess the quick answer to your question is no, this turmoil isn't over. We see it as we're talking today. FRB is under great strain. It is the case that almost 1 in 10 U.S. regional banks would fall below their minimum capital levels if all of their assets were marked to market. So I think it's increasingly well understood that one of the challenges, the number of the regional banks, the extreme being Silicon Valley Bank, one of the challenges they have is they have a lot of actually quite high quality assets, but very low yielding assets. And they have, in some cases, massive franchise problems because of that, because they're just, unless we go back to a low for long world, which I think is extremely unlikely, unless we go back to that world, they're just going to have very large earnings headwinds going forward. So there are a large number of regional institutions in the U.S. that have varying degrees of this problem. And the longer higher rates go on and the more deposits move to perceived safer places, we're going to see more, at a minimum, I'll put it politely, we're going to see more consolidation in that sector. But, and here's the big but, this is a very different situation than what we went through 10 years ago, a little more than 10 years ago. I mean, the system as a whole has more than 6 times the loss absorbency it had then. It has much higher liquidity across the system. Central banks are providing, much faster support as needed for those who are impaired. And there are many fewer interconnections between the institutions. I mean, in 2008, everybody was connected to everybody else and nobody knew who was going to fall down next, but everybody was convinced that if somebody failed, it would bring others down. And those were reasonable assumptions, certainly during the panic. That's just not the case now. We're seeing individual problems that the contagion in the system is because of similar business models as opposed to interconnections that cascade through the system. So the turmoil, I would say it's turmoil, not crisis. No, it's not over because we're in a higher rate environment. We're going to have a tougher credit environment coming as the economy slows, but it's in an absolutely different order of magnitude of what we experienced in the past.
I'm kind of pleased to hear that, because for someone who hasn't experienced it through a professional sense, it kind of feels like the world is over in some respects. So that is that's quite refreshing in some ways. My question to you is, I have Bill Ackman on the show, and he presented the view that essentially we need to guarantee all deposits in banks. And once you do that, you'll reinsert consumer confidence and turmoil will really be quashed in many ways. Do we need to guarantee all deposits in banks, Mark?
I think I'll say a couple of things. One is that what we're seeing is that the current commitment, the current structure, which does not guarantee all deposits in banks, is proving time inconsistent. So under pressure, authorities are coming in and on a case-by-case basis, effectively guaranteeing all deposits in banks. So after you have a few of those, you ask the question, it's a fair question, whether, should you just jump to the end state, which is to guarantee all deposits in banks? That's the first point. Second point, there is a bit of an issue, which is somebody has to take that decision. It has to be duly authorized. And in the U.S., that requires an act of Congress. So the effective way to guarantee all those deposits is not going to happen quickly. That's second. Third, there is a bigger argument, and maybe we'll get into this, but I'll just put it on the table, which is something Andrew Bailey, the current governor of the Bank of England, a point. He made a seemingly esoteric point, but quite an important point around the nature of money. And his point was, in effect, most people don't realize that there's a difference between money that's created by a bank, a private bank, so-called inside money, versus the money that, when people used to use cash, that they would see the manifestation of money created by the central bank, but core so-called outside money. Most people think they're absolutely interchangeable, which they are in transactions, but they assume they are in deposits, or implicitly assume. And shouldn't we, the authorities, make that clear? Okay. Last point I'd make is whether, let's say we take the Ackman plan, I'll call it the Ackman plan, and in the UK, in the US, elsewhere, we say, you know what, it's just not realistic that, Harry VC and people like you, or somebody running the corner shop who has their deposit in a bank is going to take time out to monitor the health of the bank and move that deposit when you start to get concerned about the creditworthiness. I think that is actually a realistic assumption. It's certainly totally unrealistic that individuals do that. Now, what we would have to do if we change the system so that all deposits were backstopped is to make sure that there is substantial capital at risk in the system. So somebody other than the supervisors and the central banks are monitoring those institutions. And that's why you need to have senior debt that is non-deposit debt, not recharacterized as deposit and backstop, and so-called contingent capital or AT1 capital, different words for roughly the same thing, which is capital that is subordinated and would be bailed in once the equity holders are wiped out. And it's those pools of capital and the institutions behind them that's going to discipline the system or help discipline the system on top of what the boards and the management are supposed to be doing. So you need all of those components.
So help me out here in terms of that contingent group that's external to like the core savior, which would obviously be kind of government led. Is that like a contingent of JP Morgan, Goldman Sachs, the biggest institutions who collectively come to rescue the banking system together with this guarantee? What does that look like? I'm sorry for being so naive. It's something we put in place after the financial crisis. So I said a few moments ago that, look, the system as a whole has 6 times as much loss absorbency as it had going into the financial crisis. And that's a big multiple. Part of that, a little less than half of that, is contingent debt.
So it's actually, I mean, there's various structures for this, but in effect, it's subordinated debt, which is owned by institutions, not other banks, actually. You don't want other banks to own it because that brings contagion. Let's say, I'll take an extreme example. JP Morgan fails and Goldman Sachs owned a bunch of their contingent debt. Well, then Goldman Sachs is going to be called into question because they'll take part of the loss on that. So what you want is a different source of capital for it. And that tends to be an insurance company, it's pension funds. They're the big buyers, straight asset managers as well. They're the big buyers of, I'll call them AT1 securities, which is a number of people on the pod will recognize. They're the big owners of that. And they are very sophisticated. And they do recognize that there are scenarios where they're going to end up owning equity in a stricken institution because it's failed. And in one extreme, which we saw with Credit Suisse, they discovered that they owned nothing, at least on the current version of what the Swiss authorities have done. So that's the way you have discipline in the system, and you have an additional level of protection before you get back to the state, because you don't want the taxpayer to be, second in line after the equity holder to prop up these institutions. That was the case, by the way, the taxpayer being second in line back in 2008.
Mark, I've seen all of my friends, many managers centralize their funds to the top four, the biggest names, the too bigs to fail. Why is it bad to have a centralization of wealth to the top four? And why is that not a world that we want to live in?
Well, I think, we all believe in competition, and there is value in having a broader range of institutions that are competing for that business. So they're providing better service for the business, and most importantly, I guess they're competing to provide credit to companies and entrepreneurs. And the more you move into a banking oligopoly, the softer the competition comes on both sides. So that's one reason. And then the second reason is that the more you have concentration, the more those who benefit from that concentration are too big to fail. They're essential for the system. And then that brings moral hazard into the system. All that said, look, entrepreneurs like yourself, people who are listening, should be focused not on whether or not their bank's going to go down. They should be focused on whether their investments are going to work out. So, we've got to design a system have a system that gives that peace of mind. And it's part, the first line of defense is, do you have a well-run bank? And, in the broad scheme of things, those larger institutions are well-run and they're solid. So it's understandable that money's going there.
Mark, can I ask, you mentioned regional banks earlier. What's the future of regional banks in the US?
I would say go small or go home. I mean, it's always the U.S. banking system, relatively, a very large number of institutions by number in the U.S. Kind of barbell strategy. It was dangerous to be in that awkward middle where you're a large regional and therefore you have a lot of corporate deposits above the minimum. They turn out to be much more flighty. What we saw with Silicon Valley, what we're seeing with First Republic, that's an awkward place to be. If you're a narrow regional, small, literally close to your customers, largely insured deposits, more stable funding base, you're okay. It's an okay business. You don't have a lot of growth opportunities, or you're going to get consolidated up into some of those very large institutions. So I think there's going to be really a wave of consolidation, another wave. This has happened over time, but will accelerate. And, in part, it's accelerating because the competition, not just for the regionals, but also for the large institutions, is very much coming from fintech. And as a bigger picture point, the system is moving towards a form of narrow banking as a core competitor to fractional reserve banks. In other words, banks that create their own money and leverage up. And it's able to do that. The system's able to do that because of technological changes, which make things very easy to take customer money and back it quite efficiently into the money markets and provide better returns.
Okay, so we see consolidation there within regional banking in the US. You mentioned Credit Suisse earlier. I do have to ask, and I have to thank Mark for this one, but he asked, how do you assess the balance of regulatory and bank management responsibility in the case of SVB and Credit Suisse?
Yeah, I think it's a great question. I think, you start with management responsibility in both. Management and boards are the first lines of defense. I would say in the case of SVB, it pains me to say this as a former regulator and supervisor, but much higher regulatory and supervisory responsibility in the case of Silicon Valley Bank because of a couple of things. One is they changed the rules in the U.S. in 2018 and did away with some very basic protections that we apply everywhere else in the world. Stress tests. We in the Bank of England when I was there, and subsequently we stress test the banks to a 4% increase within 12 months of interest rates all the way across the curve. Now, it seemed quite extreme at the time. It's more or less what has happened because of this inflation. But we stress tested everybody. In the U.S., they said, well, no, people under 250 billion, which is a very large number, don't have to do things as severe as that. So that's the first thing. So they weren't doing that. Then they also lessened responsibilities around what are called liquidity rules or liquidity standards and buffers. And some of those actually protect against having the extreme mismatches that places like Silicon Valley had. And then thirdly, in the actual practice of supervision, so even if you don't have those rules, even if you don't do the stress test, you just have to look at the books and the mismatches of that bank and say, this is, irresponsible. It clearly was. And that was noticed but not acted on. So I would say in that case, it's much, apart from management, it's more supervisory. I would say in the case of Credit Suisse, the challenge, it's been a stricken institution for a number of years. It's had cultural issues. It's had real risk management issues. And the authorities there have been spending time, and when I was at the Bank of England, we spent time on this as well, is putting in place as best as possible ways to minimize the risk to everybody else of Credit Suisse and maximize the ability that if Credit Suisse couldn't make it, so to speak, that it could be wound down in a relatively orderly fashion. And it wasn't perfect, but the fact is that when it hit the wall, the Swiss authorities, the international authorities had many more options than they would have had even a few years before to manage that situation. And so, it wasn't a great day for Credit Suisse shareholders or the contingent capital holders who absorbed the losses, but it meant that the depositors, the debt holders, and, the franchise as a whole could be, the first two could be protected and the franchise could be folded into UBS, which, would not have been the case, as I say, just even a few years prior to that.
Incredibly unfair question. Is FRB a stricken asset with a damaged business book, or is it a consequence of a wider macro banking turmoil situation where really it's being pulled into something that it doesn't deserve to be?
I think on the balance, it bears more responsibility for the situation it is than the macro. And let me make a macro point, which is that, if we go back to where we were, whenever it was we spoke last time, 12, 15 months ago, we're just rolling into this period where the world's moving out of low for long interest rate environment, low volatility environment, which some had interpreted as low forever, including low vol forever, and had built up books of business, and in the case of FRB and SVB, very large books of business that were low yielding, assumed low volatility for a very long period of time. And, that wasn't prudent risk management. You should have been able to see that at the time. And now that we've moved into a different regime, it is a huge headwind on the franchise. You can't just, reprice these. Nobody has an incentive to reprice their own loan. I mean, they might as well keep the terms that they have. They're certainly not going to get them again. So it's more a victim of its own situation. You could say, I guess, that the macro situation has changed quite dramatically. But one of the things you're supposed to do as a risk manager, you're certainly supposed to do this as a central bank or as a regulator, is think about the tail risks that others are not thinking about and what is possible, not what's most likely. And it was always the case that one of the very likely possibilities, one of the fat tails, was we would eventually get out of the liquidity trap, this low for long interest rate world. And to assume otherwise is irresponsible. Just like now, to assume that we're going back to that world after we get through this bout of inflation is also, in my view, an unrealistic assumption. You're just gambling for redemption on that one.
Well, I mean, that's what I wanted to ask you, which is like, when you think about kind of what's to come and the consequences, when you think about the consequences of the banking crisis on like monetary policy, how do you think that will look in the next 12 months? Let's start there. So
I distinguish between a crisis and turmoil, so I'm still going to cling to that turmoil term. But it's nonetheless serious. Like, it's serious enough that, it's going to, let's say in the U.S., it'll probably slow growth by, 0.5 to 0.75 of a percentage point. It's probably enough if people felt that the U.S. economy was on the cusp of, this narrow path between avoiding recession and having a recession. It's probably enough of a headwind that there will be a recession in the U.S. So that's material. In terms of monetary policy, I think what the central banks have done is to try to differentiate between what they need to do to keep the financial system functioning reasonably well and what they need to do to address inflation. So they provide liquidity to the banks, particularly in the United States, and that keeps those who have healthy enough business models to keep going, but they continue to raise interest rates. But the next point is that the degree to which they raise interest rates has changed. And if we had been talking at the end of February, early March, before Silicon Valley Bank, I would have said something to the effect of, I think the Fed may have to go to 6% Fed funds. Now I think they'll probably stop at 5.25. So that's 75 basis points at a minimum of shift in the stance of monetary policy. And of course, the reason for that is that there is a headwind from what's happening in the regional banking system. It is, half of consumer lending, plus it's 3/4 of the lending into commercial real estate. It's material for commercial and industrial lending as well. And, the price of that lending is changing, but actually the availability of that lending is in many cases coming to a stop, and the Fed has to react to that.
Mark, I'm a technologist. I'm a startup investor, so I'm naive, which means I'm allowed to ask questions like this. What's the speed of rate hike? Was it irresponsible? It was unparalleled to any other rate hike, supposedly, in the recent times. Was it an irresponsible speed of rate hike?
I think it was necessary. It has consequences. I think that one of the assumptions that economists, not always financiers, but economists often make, is that things move in a linear fashion, whereas, certainly technologists knows that things get disruptive. There's quantum moves. And in finance, there are situations where it isn't the case that when you move from, certainly in this case, when you move from 0 interest rates to 5% interest rates in a short period of time, it doesn't mean the cost of credit moves up lockstep with each of those moves. You get to positions where the availability of credit just stops from certain channels. We're seeing that in the regional banking sector. We'll see that in other leveraged parts of the system. I guess we saw it at the very start of this move. We saw it in leveraged crypto, which wasn't macro significant, but it was for some individuals. So I think the responsibility, dancing around this a bit, as you can tell, but as a responsibility of the authorities is to recognize that the faster things go, the more likely there are to be these, to put it politely, nonlinearities or sudden stops, and that needs to be taken into account. Yeah.
Mark, if I put you in charge of the Fed, what would you have done differently?
Well, the main thing I would have done differently is that so what the Fed did is, when we're in the depths of the pandemic, just in the run-up to the depths of the pandemic and in the depths of the pandemic, it effectively tied its hands. And it said that we, the Fed, are going to target average inflation, and we will not raise interest rates until we have the prospect of getting unemployment back to the level it was prior to the pandemic, including in various socioeconomic groups. So it also had an inflation condition as well. So it instead of anticipating where inflation was going, it changed its decision rule to a backward-looking decision rule, and that meant that they lost 6 to 9 months probably of tightening time that could have been spent initiating a more gradual tightening, squeezing out some of the excess which built up. In these late stages of a cycle, you get the excess building up, so there would have been less of that. Now, the big forces on inflation, the big global forces that help drive inflation to the high single digits, they still would have been acting. So we wouldn't have seen an appreciably different level in the short term of inflation. It would have been lower, but not, it wouldn't have stayed at 2%. We probably would have had fewer of these strains appearing in the financial sector. We'll never know, though.
Mark, before we move to climate, which I do have to discuss, is there anything that you think is very important that you don't think enough people are spending enough time on, are aware of, are concerned by, when you look at the banking crisis in the last 6 to 12 months?
I'll answer that with a little farther perspective. I think there's two consequences which might seem slightly inconsistent, but I'll say them anyways. And one, maybe a little controversial, which is, I think this probably puts a silver bullet into stablecoins, even though this is a banking crisis, because that model, and there's a lot of value in the link, obviously, between the core of the central bank balance sheet and the DeFi world or the NFT world and all that. I totally get that. But that model relies on absolutely flawless asset liability matching, not just 24/7, 365, but for decades. And what we see is that deviations from that over time get caught out and can lead to a panic. We also see that the authorities, have not been able to oversee money market funds, which is a version of this. Twice in the last, 15 years, we've had huge money market fund crises in the U.S. Haven't been able to oversee relatively simple banks like SVB and FRB. And it just, when you put those realities together, the likelihood that there would be an accident over time with a stable coin is pretty high. And the risk of that is unacceptable because it would be at the center of the payment system. So it wouldn't just be a question of who had a deposit. It would be everybody would be affected by it. And of course, the only way that you can protect against that is to, in effect, staple the stable coin to the central bank balance sheet, which is, in other words, that its whole asset side is matched one for one. In that case, that's really a central bank digital currency by another name. So that's one consequence of it. I think the other consequence, and the reason why I try to say it's a bit inconsistent, is that I do think what this does lead to, though, is the system moving more towards wholesale finance, narrow banking in different pockets, and that the funding of banks will over time become more wholesale, less retail, more volatile, more credit differentiation. Monetary policy will end up having more traction for what it's worth. And the consumer, whether it's, your fund, your companies, or you as an individual, you're going to see actually better rates as a consequence, better service as a consequence for that. But it's a pretty big change that will come from it.
That is a pretty big change. And I was like, yeah, just leave me on a massive cliffhanger there. Thanks for that, Mark. I do want to make sure, though, that we cover climate, because you spend a lot of time on it, and there's a lot of questions I just want to touch on, which is, first, what is new in net zero? Will we ever get on track, Mark? What's
new in net zero is that we're getting on track, actually, and that's not something I didn't think I would be saying this early. I'll give you some headline numbers, which is, 7 years ago when they had the Paris Accord, the world was headed to 3.5 degrees. When we had the Glasgow summit just under, I don't know, whatever it is, 16 months ago, 18 months ago, it was less than 2.5 degrees. Now, with the country commitments that are in place since then, it's 1.8 degrees. But what we have with the US IRA, with the European response, the Canadian response to the European and the American response, what's happening in Japan, Korea, on, is that a number of countries are now have put in place the policies to get on track to the key way station between now and 2050 net zero, which is the end of this decade, 2030. And these are orders of magnitude of 40% to 50% reductions in emissions. To back that up, I'll just give you 2 data points. One is that the level of clean energy investment, so renewables and other investment, has tripled over the course of the last 5 years. It's on course to quadruple again over the course of between now and the end of the decade. And then if you look at what's happened in the auto sector and the rise of EVs, 3-4 years ago, about 4% of new auto sales were EVs. This year, it's looking like it's going to be closer to 20% worldwide. Those are huge, huge numbers. And in most advanced economies, it's likely to be more 1 and 2 by the end of this decade. So the new thing is that the inflection points that we need, we're living through them right now. And so I'm not blasé, I'm not Panglossian about it, but it is pretty significant what's going on.
So I'm going to play devil's advocate here, Mark, which is incredibly bold of me considering the size of your brain and considering the size of mine, but I'm going to do it anyway. Number one, when we look at kind of size of impact, Xi Jinping and China play a pivotal role. The man has spent his entire life climbing the greasy pole of Chinese politics, which is a challenging pole to ascend. He needs to focus on growth, what China does not have, where we are seeing millions of Chinese people being sent back to rural communities in a bid to them to find work. China is in trouble. He doesn't give a shit about climate. He needs growth. Do you agree? And can we make headway with China not really being interested?
Well, I disagree with I'm going to disagree with the premise. Maybe I won't disagree with what he cares more about as a leader. He cares more about growth than short-term climate. But he and the country have made a very big bet on future growth relating to decarbonization. That's it's growth for China, and I'll come back to why it's growth for China, but it's absolutely central to the competitiveness of the Chinese economy over the course of the next 25 years. Decarbonization and AI, the 2 big drivers of competitiveness for China. And I'm going to back this up in a second, but I'll just make the core point, which is one of the pennies that has dropped for other major economies is that he's right. Xi's right about those drivers of competitiveness. And what's motivating, the IRA in the US, which is for those who haven't followed it, the big climate bill, which is enormous in its impact. What motivated that, what's motivated responses in places like Canada and others, yes, it's climate, but really it's about jobs and growth. It's about these industries. If you just harken back to what's happened in the auto sector and what is happening in the auto sector, if you're not building out an EV supply chain and you're an auto manufacturer, you're dead. Right? That train is leaving the station, to mix my metaphor, and you need to be there so climate goes there. So in terms of, is that really manifest? China accounted for half of clean energy investment last year, about 550 billion US of the 1.1 trillion. So half in effect. Renewable investments growing at 50% a year. They have more than 50% of the EV market in terms of the flow there. They are one of the biggest, in fact, the biggest source of clean tech finance is in China. They're the dominant player in solar and wind, the supply chains for that. So, he's getting growth out of that. To personalize it, China's getting growth out of that. And that's why he cares, and that it's having the spillover effect on other countries who are realizing they need to care about it as well.
Okay, so I asked this question of Mr. Mark Evans, and he gave me a fascinating, and this was this week, so I'm going to compare your statements here. And I said to him, you can invest in the future of one, the US or China, over a 10-year period. Which do you invest in?
I'd invest in the US.
Why?
Okay, why would I do that? I mean, partly that we've got a track record and past performance isn't, an indicator of future, but the main components of what has driven American exceptionalism over decades, more than a century, still are there. I mean, still partly because of immigration, but it's still the case that the quality of skills is amazing. The financial ecosystem, yes, it has SVB and FRB, but it also has the whole VC complex. I won't tape myself by only naming one or two of them. Of course, you're by extension, my host here is part of that. It has still the best mechanism of creative destruction in the world, I think. There's some who argue European competition policy is now stronger. I'm not totally convinced. Notice that U.S. competition policy has just been reinforced. It has a huge market and has ability to get market access. So it has all of that. And, they've just pivoted. America, when it moves big. And so in this space, in climate, which is one of the big drivers of growth going forward, they have the U.S. in this space of the time since we last spoke has gone from well behind Europe, the U.K., amongst the major industrialized countries in addressing climate change to putting in place, the measures now driving with the investment that they're they will overtake in the course of a few years. So I would do all of that for the U.S. And then with respect to China, I mean, yes, massive market. Yes, they've got all these components. Yes, they're going to do well in this. But what comes with that is, issues around property rights, consistency of government policy in some cases. I probably am better off leaving it in the why the U.S. is so positive than enumerating a bunch of issues in China. I think it's a simple choice. And what did Mr. Evans say of interest?
Mr. Evans agreed with you, and he agreed with you, citing several problems with China and also several positives of the U.S., which for his sake I'll probably leave for him to tell you over dinner. Yeah. Can I ask you, for Europe, is Europe weaker than ever, Mark?
No, I don't think it is, actually. On the face of it, it's obviously there's a massive shock with the war and the energy hit that comes with that. And so there's reason to think that it might be, but I'm going to take the other side of this. First is that the financial system, this is unusual. I don't think I've ever been in a position in my career where I've been able to say the European banking system is in better shape than in most other countries, and certainly the U.S. in this case. But that is the case. So their financial system is solid. I know Credit Suisse failed, but it had relatively unique circumstances, and the core of the system is strong. The second is to say that they're using most of the levers of policy now, so fiscal policy is not a permanent headwind to growth there. Thirdly, they've got a pretty good framework in place for the climate, the net zero transition. So the U.S. is going to catch up and I think pull ahead, but Europe's been doing pretty well there, and that's driving investments. So I don't think they're weaker, and at least initially, and it's more than initial because it's been longer than a year, I think the European response to the crisis being the war, has made them stronger. It will make them stronger in the medium term. It's accelerated some things that they needed to do.
Can I ask Mark a really unfair one? And again, I'll blame Mr. Evans for this one because I can do. Which governments and big corporations are acting more than they're talking about climate initiatives?
I would say acting more than they're talking. Look, I would say a company like, and they talk about it, but a company like Walmart, in terms of, Walmart's got, I'm not going to do them justice, but it's certainly well over 1 million SKUs in their various stores. And if you, as a retailer, you ultimately take responsibility for what are called Scope 3 emissions, so the emissions all the way through the value chain, which means you need to know what the emissions are of all those products that you're putting on the shelves at Walmart. And they are rigorously going through that and then working with their suppliers to, optimize those and get them down. And I don't know that given the complexity and scale of that business, you could talk enough about it and still, given what they're doing, they're saying less about it than what they're putting into place. In terms of governments, this is recency bias. I was in Australia a few weeks ago, and I'd say that the shift at all levels of government in Australia is underappreciated. And, that's a pretty can-do country. So when you have a decisive shift, what we're seeing is pretty big shift in activity there. And we'll hear a lot more about it.
Which are talking more than they're acting?
No, that was the unfair question. I thought it was a very fair question to ask me the easy. Which are talking more than they're acting. On the company side, I think big oil is talking more than they're acting. I don't think that the scale of this, in most cases, the scale of investment in the energy of the future, the relative investment there, which is a relatively small percentage of overall cash flow and a smaller percentage relative to conventional investment, is consistent with where the energy sector is going. So they all have a lot of talk, but in most cases, where the money is actually being put is not consistent with that. I'm going to give an example, which is that the reason I was in Australia is that Brookfield, company I work with, is leading a bid on a company called Origin in Australia, and it does a couple of things, but one of the core things it is the biggest generator and a retailer of electricity in Australia. So it's got about 4.5 million customers, but most of its generation is coal, and then they buy on a merchant basis in a bunch of gas generation. So as a whole, it's a meaningful proportion of Australia's emissions, 7% of Australia's emissions as a whole. And Origin basically had a shareholder base that liked the dividends that came from that core steady business. But in effect, it's a transition trap, because what they need to do for where Australia is going is to invest about 20 billion plus Australian in building up clean power, shutting down the coal, and operating for another 50 years, not another 10, 15 years. So we've been able to come in, we've made a bid at a substantial premium to, the undisturbed share price, a 50% premium. And we're going to, not have a dividend. We're not going to take a dividend out of it. And we're going to invest in that transition, the 20 billion plus, shut down the coal, move forward, and give the thing a future and make a good return for our investors accordingly. I bring that out in part because it's an example of the value of going to where the emissions are and the scale of what that, but also to try to illustrate the broader point. I think there are a number of companies that, and in the energy sector, this is one of the challenges, that aren't moving fast enough for where the world's going and have shareholder bases. And part of the reason is they have shareholder bases that have a different horizon and could get to the point where the terminal value of the enterprise is being affected. And so what appears to be a good yield in the short term is actually quite a poor yield over the medium and long term.
The subsequent question is very much the same as in technology then, is will those incumbents embrace innovation and move fast enough, or will we see innovators embrace, bluntly, distribution and engage with distribution fast enough to challenge the incumbents? Where does the value accrue there your mind?
Yeah, I think that's the history would say that it's more likely to be the latter, right? We see that, time and time again in technology. We saw it in the steel sector, classic example. It has a fancy name, the innovator's dilemma, Clayton Christensen's work on that. So it's almost the default. And the challenge, there are exceptions to this. Netflix is an exception to this. Amazon was early days. Amazon was an exception. Microsoft, I guess, in technology would be an exception. So it's not destiny, but you really have to fight against it, and you do have to not cannibalize your business, but you've got to. Well, in effect, you do have to cannibalize your business. You ultimately have to take the cash flows from a very nice business and invest on something that's not a sure thing, and that's hard to do.
Final part of that question: which governments are talking more than they're acting? And then we'll do a quick fire.
Yeah, I think I am the United Nations Special Envoy, so I would have said the U.S., but I can't say that anymore. I think it's a relative game, so I'd now say that the time has come for the next phase of what the UK is going to do. Maybe that's the best way to put it, right? So it's like anything. You can be out in front, you can be leading, but then others catch up to you, start to lap you. So I think the UK has had a good track record. But I'll quote the Climate Change Commission, which is this independent body that does an assessment of the government. It says that more than half. It does not yet have everything in place in order to reach its medium-term targets, and has given 300 different recommendations of what's necessary to do it. So I guess that would fall into the talk more than act.
Well, that's good. I'll ask Rishi on the show when he does come on, ask him about 300 different recommendations. That must be fun. I want to move into a quick fire round, Mark. So I said a short statement. You give me your immediate thoughts. We're going to start with one that I loved. I can't wait to hear this. What do you miss about not being a central bank governor?
I miss. I guess I miss being at the center. In other words, when there's things like what we've been talking about, banking turmoil, other things, being in the room, being able to influence it more directly for good or ill. And certainly, during the time I was central bank governor, I would say I was at the center, and I like being there if I can be.
I'm going to be cheeky, but I feel like we have a rapport where I can be. Why are you not in politics, Mark? You seem like a gifted political advisor, politician. It's your home. Why are you not in politics?
The big thing, I'm trying to help break the back on climate, and I'll do that by whatever means possible. And I've got seats at the moment where I can influence it. So I would say, politics if necessary, but not necessarily politics.
What do you not miss about being a central bank governor?
Well, if I go back to being at the center, I don't miss when the center doesn't hold, the center not holding. So I don't miss when things are spiraling out of control and you're not on top of it.
What do you know to be true that others do not agree with?
There's no net zero without nuclear power. A lot of people don't like to think about nuclear and think that there's an easy ride to shut it down. But in fact, we have to grow it by another 50% between now and 2050 worldwide.
What have you changed your mind on in the last 12 months, Mark?
That fusion power will be commercialized.
Who's your mentor?
I'll give you three, but it's a common thing. There's a guy I worked with when I was at Goldman Sachs named Craig Broderick, who was the head of the credit department. When I was a central banker, I would say Mario Draghi. Now that as an investor, Bruce Flatt is the CEO of Brookfield. And I think the common thing of all three of those individuals is that you have to both sweat the details and see the big picture. So, the challenge in whether it's managing risk or conducting policy or investing, it's not enough just to get the tectonic forces right and the direction right. You actually have to do the work.
Penultimate one, if you could change one thing in climate, what would it be?
If I could change one thing, it would be that we started taking it seriously when you were born. So, but given we can't go back in time, I would say we need a big pool of capital, concessionary capital, to shoulder particularly foreign exchange risk in emerging economies. Let me explain that quickly, which is that 2/3 of the emissions in the world now come from the emerging world. Now that includes China. China's about 30% of global emissions. But you've got 35% plus of emissions coming from countries that most private investors never visit, don't have exposure to, don't want to know about, and would be taking quite large currency risks. And it's unhedgeable. And that means that a lot of the capital is uneconomic to get there. Now, there's other risks and there's other issues, but we need to have a big pool of capital that will hedge that out. It's not going to come from the private sector, and given the time horizons, so we need to design that. And it's one of the things I work on the side.
Final one. We do this again in 2028, so 5 years out. Where's Mark then?
I would like to think that I'm no longer a special envoy because what the objective is, so I'm going to define it in the negative. I'm no longer a special envoy because I'm tired of not being paid by the UN, but more seriously, because the kind of things I'm working on are just so run-of-the-mill, they're mainstream, that everybody does it, and that's when you have successes that, this is just carbon competitiveness is just part of the value equation. It's part of the way things are analyzed and capital flows naturally. And so then at that point, what am I doing? I'm an intern at Harry VC by that point.
Mark, listen, I've loved
That'd be
this.
fantastic.
And sadly, you will not be able to be an intern because I'm actually special envoy in 5 years' time. So alas, your job has gone. And I have a new one. Mark, I love this. Thank you so much for doing it with me. I've learned immensely, and you've been a star, my friend.
Great. My pleasure.